Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 105th CP program organized by AASB of ICI this year. Today, our topic is very relevant and very important, that is the going concern. And in order to tackle this topic, the webinar's topic, Demystifying Going Concern in Audit, we are having with us learned speaker, CA Astha Gupta ji, on behalf of AASB of ICI. I extend our warm welcome to you, ma'am, in this 105th webinar. Welcome to you, ma'am. Namaste.
Thank you. Thank you.
And as we are already aware that we have covered all the auditing standards as well as all the aspects of the balance sheet, like asset side and liability side auditing aspects, while audit consideration while auditing the asset side as well as the liability side. Now we are having these major important topics which we are supposed to cover. So today's topic is very important and relevant, that is the going concern. So it is my proud privilege to share with all of you the brief profile of our today's speaker, C. Astha Gupta ji. C. Astha Gupta ji is a partner at Delhi-based firm since last 2.5 years, and he is having professional experience ranges across statutory audits, personal and corporate taxation, income tax assessment, and GST compliances and advisory. As far as his past work profile is concerned, she was senior consultant with risk advisory team conducting internal audit and risk assessment projects catering to telecom sectors for more than 3 years. And he was audit executive with an in-house global internet audit team of a French IT multinational corporation for more than 2 years. She has convened technical sessions organized by Accounting Standards Board of Institute of Chartered Accountants of India. She is a member of the organizing committee and joint auditor at the Bharatiya Vitt Salahkar Samiti, a leading think tank of Indian finance professionals. She has deliberated GST sessions as a part of the role as a co-convener of Bharatiya Vitt Sansthan Samiti as a GST group. She is a member of editorial advisory panel of the Chartered Secretary, the official monthly journal of the Institute of Company Secretaries of India. She has just allocution competition of CA students organized by NIRC of the Institute of Chartered Accountants of India. She has won technical paper presentations across the country in the National Conference for Chartered Accountant Students organized by the Board of Studies of Institute of Chartered Accountants of India during her student days. So once again, welcome you, ma'am. And I would like to request you to please start your deliberation on going concern. Over to you, ma'am, please.
Thank you for the brief introduction, sir. Good afternoon, everyone. I am CA Astha Gupta, and I would like to convey my heartfelt thanks to the AASB of the ICI for giving me this esteemed opportunity to present amongst my professional fraternity. So without any further ado, let's demystify the world of going concern. Is my screen visible, sir?
Yes, ma'am. Yes, ma'am.
Okay, fine. Just a second. Yeah. So today's agenda will be broadly across these 3 points. First, I will introduce the concept of going concern. Then I will walk you through the going concern from management responsibility perspective. And in the third and the final part, I will talk about going concern from auditor responsibility perspective. The presence of the going concern concept has been taken from various reference material. We have our Accounting Standard 1, then Ind AS 1, International Accounting Standard 1, SA 570, International Auditing Standard 570, Section 134(5) of the Companies Act 2030, which describes the director responsibility statement. Therein, the clause D states that directors should prepare the annual accounts on a going concern basis. And lastly, the implementation guide to the standard on auditing issued by the AASB of the ICI. Before I start with the concept of going concern, we will delve a little deeper into its origin. This is a quick refresher slide for every one of you. I'm sure that all of you know that what fundamental accounting assumptions are as per AS1. So there are 3 fundamental accounting assumptions, which basically they underlie the preparation and presentation by the management. They need not be specifically stated unless the management does not follow them. Their acceptance and usage is assumed. So the first fundamental accounting assumption is going concern, which we will be covering in the slides. Second is consistency. That is, my accounting policies are consistent across all financial years when the financial statements are prepared by the entity. Third is the accrual concept, that the financial statements are prepared on mercantile basis, and this is also a requirement of the Companies Act. This is where in the concept of going concern comes in. In this slide, I have covered the going concern basics, wherein I have drawn parallels between Accounting Standard 1, IND AS 1, and SA 570. Just a small disclaimer, majority of my slides will be dealing with the coverage from AS1 perspective. However, if there is any specific requirement of IND AS1 and SA 570, I have specified that. So first we will begin with the coverage of going concern under para 10A of AS1. It states that going concern is one of the three fundamental accounting assumptions. It states the definition of going concern, very important, which is that the enterprise is continuing its operation for the foreseeable future, which means that the enterprise has no intention or no necessity of liquidating or curtailing the scale of its operations. There is absolutely no need for the entity to shut down its shop because the events and conditions are favorable. When I say negative disclosure in this particular point, this means that the management is required to disclose regarding the going concern assumption only when the financial statements are not prepared as per the going concern. If the fundamental accounting assumption, any of the three, all of the three are being followed, then there is no disclosure required, and hence the term negative disclosure. We will go to IND AS 1. If we refer para 25 to 26 of the IND AS 1, it states that the financial statement are to be prepared on going concern basis unless the management either intends to liquidate the entity or cease trading, or it has no realistic alternative but to do so. So again, the financial statements will be prepared on the going concern basis because the entity can see that it can continue in the coming future and it has no reason to stall its operations. Very importantly, it states that the going concern assumption has to be tested by the management. It is the management's responsibility on the basis of certain financial operational indicators and parameters. The going concern assumption has to be tested by the management. Now, this states that they need to be given two disclosures under IND AS 1. Now, this is the differentiating factor between the concept of going concern between AS1 and IND AS1. In IND AS1, two disclosures are required to be given even if the management is preparing the financial statements on going concern basis. If you recall, in AS1, I had mentioned that the going concern, the disclosure regarding going concern is to be given only when it is not being followed. But in IND AS1, it has to be given in both scenarios. Scenario 1, that it is being followed, and scenario 2, when it is not being followed. We will discuss the disclosures in the later slides. Coming to standard on auditing 570, if we refer para 2, it is stated that the financial statements are to be prepared on the assumption that the entity is a going concern and will continue its operation for the foreseeable future. It also states that the general purpose financial statement, they have to be prepared on going concern accounting unless the management either intends to liquidate the entity or cease its operation. So if we draw parallel between all these three aspects, whether it is AS1 or IND AS1 and SA 570, the definition of going concern is common. It is similar with very slight difference with respect to the disclosure aspect. Now that we have understood the basic of going concern, we will look at going concern from the management responsibility perspective. Going concern is a management responsibility. So all of us are aware that the financial statements are to be prepared by the management as per the applicable financial reporting framework. It is the primary responsibility of the management to prepare them. If we refer para 26 of IND AS 1, it states that whenever the financial statements are being prepared by the management, it is the management responsibility to make an assessment on testing indicators of the entity's ability to continue as a going concern. The management has to first establish whether the events and conditions are such wherein it can prove that its entity will continue for a foreseeable future as a going concern. And when the management assesses the going concern assumption, it will take into account all the current as well as futuristic information. And that period of the futuristic information should be at least 12 months from the end of the reporting period. Let me explain this to you by the help of a small diagram. So in this particular timeline, which is shown in the slide, if the management is at the end of the reporting period, financial year 21-22, on 31st March 2022. And now, if it has to test its going concern assumption, then the events, condition, factors, the period of testing should be at least till 31st March 2023, which is 12 months from the end of the reporting period. However, if it wishes to go beyond 1 year, for example, it gets a project whose life is 2 years, and during the course of the project, the management is promised that they will be getting milestone-based payments. So in this case, the assurance of the going concern assumption can span across 2 years, which is obviously a better situation than 1 year. But minimum requirement is that the period of coverage should be at least 12 months from the end of the reporting period. Similarly, if we refer para 5 of SA 570, this also states that the management responsibility is to assess the entity's ability to continue as a going concern, which involves making judgments and testing the assessment. Once that we have established that the primary responsibility of the management is to assess the going concern assumption, now in the upcoming slides, we will understand that how does the management assess its ability to continue as a going concern. So the assumptions can be broadly categorized into two parts. The first are the financial indicators. The second are the operational indicators. Now I have enlisted both of these indicators. It's quite a big list, but it is not exhaustive. It is good to begin with. You can obviously, depending upon the nature of the business and other aspects, these indicators can be increasing. So first, we will discuss financial indicators. Working capital deficiencies. If the current liabilities of the entity are more than the current assets, that is, the recoverability is very low, this results in working capital deficit. This is a red flag from going concern perspective. Next, we have negative net worth. The total liabilities of the entity are more than its total assets. The net worth could be negative because of the accumulated losses, or the dividend has been drawn from the reserves. And this also acts as a negative factor when it comes to going concern assumption. Negative cash flows from business activities. This simply means that there is more outgoing money than incoming money, that my expenses are more and I'm not able to recover the money from my current assets, say debtors, so that I can pay off and meet my daily day expenses or purchases. So this also is a dangerous situation from a going concern perspective. Next, we have reliance on short-term borrowings to finance long-term assets. So short-term borrowings are easy to obtain. And when an entity uses the sum received from short-term borrowings to fund its long-term assets, that money gets blocked in the long-term assets, the recoverability period is high. And then it falls short to repay the short-term borrowings. So this is also a negative indicator as far as the going concern is concerned. This is also a requirement of CARO for the auditor to report wherein the short-term borrowing funds are used to finance long-term assets. Next, we have adverse key financial ratios. So there are certain key financial ratios which basically give the report card of the financial health of an entity. These ratios can be the current ratio, debt service coverage ratio, inventory turnover ratio, debtor turnover ratio, so on and so forth. So it is a good practice always to analyze these ratios in order to understand where the entity is standing from financial perspective. If these ratios are adverse, then that means it is a red flag from going concern perspective. All of you must be aware as well that there's a recent requirement by the Schedule 3 to report a list of 12 ratios in the financial statements. It was applicable first time for the financial statements of financial year 21-22. It also required that if there is a variation in the ratio between the previous year and current financial year, more than 25%, the management is also required to give the reason for the variation. So it is a very important financial indicator from going concern perspective. Next, we have recurring operating losses. If an entity is making operating losses repeatedly, then it is something wrong with the management. It is not able to recover those losses. And that also is a risky situation as far as going concern is concerned. Inability to pay creditors on due date. Now, if you are procuring the raw material or any other goods from your creditors and you're not paying them timely, this can result in a bad market image. It can affect your credit terms with them. They can also file a legal suit against you. So this also acts as a negative indicator of going concern impairment. Default on loans or similar agreements. With the towering cases of non-performing assets lying with the financial institutions, default in loan is a very serious offense and it is not taken lightly these days. So if the entity is not able to repay its loans, then it is a red flag from going concern perspective. Debt restructuring. Debt restructuring means that the entity is basically forwarding its liability to pay off the debt by taking up certain instruments. So it basically shows the weakness in the management to pay off its debt in a timely manner, that it had to take the route of debt restructuring to defer its liabilities. So that can also be a red flag and it can indicate going concern impairment. Excessive or obsolete stock. Non-moving stock or slow-moving stock, which is not being realized, is a sign of blockage of your working capital. If the entity is not able to sell it off, then that means it is not a good situation from going concern perspective. As far as obsolete stock is concerned, let me give you an example of entities that were dealing with BlackBerry devices. Now, as you all know, now the BlackBerry device has become obsolete. So at that point of time, due to the fall in demand for BlackBerry device, and any entity who had like stock of BlackBerry devices, in that case, it will be that stock will have no value in the market. So that will also be an indicator of going concern impairment. Next, we have unable to obtain finance for new product development or essential investment. This is a very common scenario in the startup world, where in startups, they come up with an idea, they also make their minimum viable product, but they're not able to generate investment from potential investors, or they cannot get seed capital, and hence they cannot finance their product development. So this, not at the start itself, they're not able to launch the product, leave alone the operations. So that means it is a impairment of going concern. Next, we have disposal of substantial assets. Now, if an entity is disposing of its assets, it can be meant that it is cutting down its operation, and hence it does not basically foresee continuing in the future at the same scale. So that can also be a red flag from going concern aspect. Application filed against corporate debtor in NCLT. If we refer to the provisions of the Insolvency and Bankruptcy Code, a corporate debtor is someone which owes money to the entity. And when the entity files application against such corporate debtor, that means the corporate debtor has become insolvent and there is a question mark upon recoverability of the amount from such debtor. So in this case also, if the entity is highly dependent on such corporate debtor or the amount involved is so material, then again, the going concern can be impaired. Sick entity under any salary definition. This is self-explanatory. Sick entity, the sick companies that are defined in the Companies Act or the Sick Industrial Companies Act statute. So if you have all those conditions, then in that case also, it means the going concern is impaired. It is not in a good condition. Maturing borrowings without prospects of renewal. If a company is heavily dependent upon a financial institution for meeting its working capital commitments, and it has to take loans repeatedly, now suddenly due to some reason or the other, the financial institution has lost trust in that entity and does not renew the loan. So again, the going concern requirement gets impaired in such a scenario. Next, we will move on to certain operational indicators which the management should consider while doing the going concern assessment. First, we have work stoppages or other labor difficulties. So there are situations, especially in manufacturing segment, wherein the labor union goes for strike for certain days, weeks, sometimes even months. For months and months, the operations get stalled and the operations get adversely affected. So this is a sign of going concern impairment. Management intentions to liquidate the entity or cease operations. This is the basic condition to understand if the entity can continue as a going concern or not. This is the intention of the management to not to continue its operations, and hence it is not a going concern. Loss of a key management or staff. So if the key management personnel is absent from the top layer of an organization, that means there is no one to guide the organization or to make strategy for the continuity of the operations of the organization, and hence is a red flag from going concern perspective. Substantial dependence on the success of a project or a product or asset. So sometimes there is a high dependency of an organization on certain only on one kind of a project, product, or asset. And if due to some reason or the other, it does not work out in the future, and then there is no fallback option for the organization, then it is in a very sticky situation and the going concern gets impaired in this scenario. Emergence of a highly successful competitor. Now, this is a very external factor that the entity is in a certain line of products and it is trying to get hold on its market. And out of the blue, a highly successful competitor comes in and takes its share of market and also, captures the entire market. So unless the management comes up with some alternative to deal with this situation, till that point of time, there is a doubt in the management to continue as a going concern or not. Technological obsolescence. In my previous slide, I had mentioned about BlackBerry technology. Also, we have examples of compact discs, DVDs, cassettes, pagers. So all these organizations who were working with these devices, there was a point when this technology got obsolete. And if they could not come up with any alternative product, so that means that going concern was impaired. Loss of a major market or principal supplier. So when an entity is overly dependent upon a certain major customer or certain principal supplier, and if that particular principal supplier customer becomes insolvent or does not wish to continue business with the entity, then again the operations of the entity get adversely affected, and so does the going concern assumption. Loss of a key franchise, license, or patent. Now again, any entity which is whose entire operations they are based upon a certain franchise or a certain license and patent, and due to some reason or the other, say there was a legal suit in a particular license where they lost or in a patent, then again it has an adverse impact over the organization and hence on the going concern assumption as well. Next, we have pending legal proceedings that might jeopardize an entity's ability to operate. So if you consult with the legal consultant and if they state that the legal position of the entity is not favorable, and whatever factors and whatever cases that are going on can have a negative impact on the organization as a whole, and the impact will be very material, then in that case, the going concern becomes questionable. Non-compliance with statutory requirements. If an entity is not disciplined in meeting its statutory dues, whether it's GST, whether it is TDS, whether it is income tax, then it shows lack of discipline, lack of intent of the management. Although it does not have a direct impact on the operations, but it is a useful indicator for raising a question mark over the going concern assumptions. Changes in establishment or new legislation or government policy. With government becoming more and more conscious about climate change and environment, if at a certain point in the future, it comes up with the provisions to, cancel the license of all diesel vehicles, then all those entities that are dealing with diesel vehicles, suddenly their operations will come to a halt and their going concern will be impaired. This is an example to explain this particular operational indicators. Now that we have understood major of financial and operational indicators, this is how the management assesses and establishes whether its entity can continue as a going concern or not. First, this is basically the fact gathering level. Now, how does the management conclude if the entity is a going concern or not? This I will explain with the help of 4 scenarios. Scenario number 1. The management has no significant doubts about its entity continue as a going concern. Fine. And because it has no doubts about its entity continuing as a going concern, the financial statements are prepared by the management on going concern basis. If we refer to my previous slide on AS1, I had stated if the going concern assumption has been used, then there is no requirement to give disclosures in the financial statements. So this is a very simple scenario wherein the management is correct in making its assumption regarding going concern because there is no significant doubt. There are no such event and conditions, and it can foresee its operations to run in the upcoming future. Scenario number 2. Before I explain this, I would like to state an example from my practical experience. One of my clients was a chief supplier of oxygen concentrator during the COVID era. And they made a kill of a fortune during that point of time. The revenues soared up, the profits also soared up. It was a good win-win situation for them. So now, when the COVID period ended, there was a question mark in the mind of my client that, I cannot continue selling these oxygen concentrators to the existing client base because it is a one-time purchase. And secondly, the COVID period, thank God, has ended. So this resulted in creating a significant doubt about the entity of the client to continue as a going concern. So now when they were about to close their financial year, they came up with an idea that these oxygen concentrator can be supplied to alternative customer base in the form of hospitals, nursing homes, senior care agencies, and other establishments. So when they came up with this idea, they obviously on the basis of the experience, they could establish that yes, we can sell the oxygen concentrators to this alternative customer base. So if we refer point 2 in my first column of this table, they took the mitigating action of searching for an alternative customer base, which was just sufficient to make the going concern appropriate. So because they could foresee and they had experience in selling oxygen concentrators, they could foresee that their entity will continue the operations in the same product, but with a different customer base. And with this comes the third point, wherein the client determined that there is no material uncertainty regarding its continuing as a going concern. So on the basis of these 3 factors, the management concluded and prepared its financial statement on going concern basis. With this, I will give a passing reference to Ind AS 1, which requires that in such a scenario, the management is required to give certain disclosures. As an auditor, even I would suggest it is a good practice to give these disclosures, even if the entity that is being audited is following AS1. Having said this, the disclosures will be first, the entity has to state the events and conditions. In my example, the condition of the fall in supply, the fall in demand of the oxygen concentrators, which caused a significant doubt in the entity's ability to continue as a going concern. Second disclosure will be that the management's evaluation of the significance of those events and conditions in relation to meeting the ability to meet its obligation. Obviously, because the oxygen concentrator will not have the same demand, so this can affect the ability of the entity to meet its obligation. Disclosure 3, the management's plan to mitigate the effect of the event or condition, which is it looked for an alternative customer base, and on certain experience, we realized that, I can make same kind of sales to the same customers. So this was the mitigating action. And fourth, significant judgments made by the management as part of its assessment of the ability to continue as a going concern. Because of its prior experience, because of its good professional network connect, it realized that yes, this I can keep on selling the oxygen concentrator, and I can continue my operations in the foreseeable future. That is why it is a going concern. So these disclosures become very important in this kind of a scenario, wherever there is a doubt in the mind of the management. Now let's move on to scenario 3. Scenario 3, if we look at the description, I will continue with the same example, but I will tweak the facts a little. So my first aspect about rising of the doubt will remain the same. That is, the oxygen concentrator, suddenly there is drop in demand, COVID period has ended. So what will the management do? Second, mitigating actions just sufficient to make the going concern appropriate. Now, in this case, the change in the example that I'm making is that suppose the management realized that the technology of the oxygen concentrator that was being used will not be relevant in the post-COVID era. So now they will have to look for an alternative product itself. So based upon the kind of clientele it had, the kind of staff it had, and the professional experience, they realized that they can venture into the new field of geriatric care products. So to explain to you, geriatric care products mean products that are used by aged and old people to carry out their day-to-day activities. For example, walking, taking a shower, getting up from the bed, using the washroom, etc. The management realized that there is dearth of such products in a country like India, and also the population, we do have a certain percentage of aging population, so they can cater to them. So now in this particular scenario, this decision of foraying into a new product line would become a mitigating action. In order to make it sufficient to ensure that the entity continues as a going concern, they decided to carry out certain market surveys. They also prepared a feasibility report. They consulted with the people who are already in the market, and they trained their staff, they strategized. So these were the mitigating actions that they took to ensure that, yes, even with the new product of geriatric care products, we can continue as a going concern. With this, I've covered the first two conditions of the scenario. Now, this third condition is very important, that even though they have made considerable efforts in the field of geriatric care products, and they have done the feasibility study, they have trained their staff, they have also ran some promotional campaigns, but there is a material uncertainty regarding this product becoming successful and meeting the same level of turnover as the oxygen concentrator. So this caused a little material uncertainty about the going concern to remain, even after considering the mitigating actions in the form of sale of these geriatric care products. So in this scenario, the management will prepare financial statement on going concern basis only, but it has to give certain disclosures. The first disclosure is same as before, that they have to give the event and condition which resulted in significant doubt in their mind, which was the drop in demand of the oxygen concentrator. Second is the management's plan to deal with the event or condition, which is the change in the product to follow into a new market altogether. Third, and the most important disclosure is, I will read it out to you, that there is a material uncertainty related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern, and therefore that it may be unable to realize its assets and discharge its liabilities in the normal course of business. They are giving this declaration that yes, in spite of taking the mitigating action, my plan to foray into a new market so that I can recover the sales that was lost on account of lack of sale of oxygen concentrator, there is a slight chance of causing doubt over the going concern assumption. This is the most important disclosure in such a scenario that has to be given by the management in the financial statements. Last disclosure is the judgment, the effort that they made, strategizing, training, marketing, and running promotional campaigns regarding the geriatric products, so as to assess that its ability can continue as a going concern. Scenario 4. In this scenario, continuing with the same example, now suppose my client decided that, okay, the COVID era has ended, and the oxygen concentrator with this particular technology will have no demand in the market. And let's assume that it did not have enough financial resources or bandwidth to expand its operation. So it decides to slowly keep on shutting down its operations, either like immediately or in a phased manner. So this shows the intention to liquidate or to cease trading, or and having no realistic alternative but to do so. So in this case, it is very much clear that the management does not wish to continue its operations in the foreseeable future. So in this particular scenario, the financial statements will be prepared on an alternate basis. Please see, it is not to be prepared on going concern basis, but an alternate basis, that is on liquidation or market rate basis. Along with the preparation of the financial statements on alternate basis, the management also is required to give these disclosures, wherein first, it needs to state the fact that the entity will not continue as a going concern in the foreseeable future. Then secondly, it will state that it has used liquidation or market rate basis of accounting for preparation of the financial statements. And third, it will describe the conditions, that is, the drop in the demand of the oxygen concentrator and no other alternative being available with the management, which resulted in giving this significant doubt in the mind of the management regarding the going concern assumption. So, with this, we have understood the four scenarios. For the sake of convenience, I have prepared this summary slide, which will quickly recap the four scenarios in one go. In first scenario, the management had no significant doubt about going concern. Its operations were running as usual, and there is no reason to have doubt in the mind of the management. Scenario two, going back to the example, the oxygen concentrator will not sell at the same level, but it looked for an alternative customer base, which was the mitigating action. And because of its prior experience and certain factors, whether it's financial or operational, the management realized there is no material uncertainty. Scenario three, same example, but the oxygen concentrator technology has become obsolete. Therefore, it caused a significant doubt in the mind of my client's management, and it took the mitigating action in the form of foraying into a new product, that is the geriatric care product sector, so as to make the going concern assumption appropriate. It took actions in the form of training its staff, doing its technical feasibility studies, running promotional campaigns. In spite of all this, because it was a new field and there can be jitters, so there was material uncertainty in the mind of the management about the entity to continuing as a going concern, even after the mitigating actions of entering into a new field were taken. In all these three scenarios, the management will prepare the financial statements on going concern basis. In scenario number 4, now the management knows that the oxygen concentrator will not be sold and it does not have enough resources to expand its operations. So slowly, it intends to shut down its operations or liquidate them. In this scenario, the financial statements will be prepared on an alternate basis, either liquidation or market rate, but not on the going concern basis. You can see here that with each scenario, the situation of the entity is deteriorating in terms of its operations. I hope that the going concern assumptions from management perspective are clear. Now we will come to the next part of my slide deck, which is regarding the responsibility of the auditor when it comes to going concern. So once the management has established that its entity is a going concern, then the responsibility of the auditor comes in place. And the responsibility of the auditors are defined in paragraph 6 and 9 of SA 570. So the management assessment has to be evaluated by the auditor. And for this, there are 4 steps. The first step is for the auditor to review the process, which was followed by the management to make its assessment. In this case, the auditor will refer to the financial and operational indicators that were used by the management to understand that what was the process it had followed to make the assessment. Second was the checking of the assumptions by the management on which the assessment is based. Once the assessment has been made by the management makes certain assumptions. So those assumptions also need to be shared with the auditor so that it can establish that the going concern assumption was appropriate or not. Third, review the management's plan for future action and its feasibility. The management plans, I mean, whatever mitigating actions they are taking or whatever plan they have in store to ensure that the entity continues its operations for the foreseeable future, that needs to be shared with the auditor so that again it can validate the assumption of the going concern of the management. Lastly, the management needs to share appropriate audit evidence with the auditor so that the auditor can conclude that the going concern assumption is correct or not. To perform all these four steps, the auditor has to follow certain audit procedures, which I will be sharing in the next slide. Now, the audit procedures, again, they are not exhaustive, but they are good enough to gather evidence and to give opinion on the going concern assumption. So let's begin with the audit procedures. The first audit procedure is the analyzing of the cash flow, profitability statement, and other forecasts that are made by the management. So in this particular procedure, the auditor should obtain the cash flows and the certain forecasts that are prepared on various periodic basis and gauge the financial indicators that I had discussed in the previous slide to see if the going concern assumption is appropriate or not. The second audit procedure is regarding the analysis and discussion of the entity's interim financial statement. Now, if the entity has prepared its interim financial statement, then the auditor needs to understand the basis and can question the validity of the same by again referring back to the financial indicators. Third is the reading of the terms of debentures and loans, agreements, increase in capital. Once the audit evidence in the form of debenture agreement, loans agreement are gathered from the client, then the auditor can check if the actual terms are favorable or not, if the entity is able to meet these commitments. For example, in case of a loan, there is a requirement to create charge on the MCA website for the companies, etc. All these steps have been done, and it should specifically look out for any kind of breach of these conditions so as to comment upon the going concern impairment. Next, minutes of meetings. So minutes of meeting is a very essential evidence, whether it is a minutes of meeting relating to a board meeting, relating to shareholder meeting, because it gives us an insight for the checking of the financial difficulties or any other operational difficulties that are existing within the management but are not being communicated to the auditors. This is a very important audit evidence. Next, we have inquiring from the entity's legal counsel regarding the existing of litigation and claims. So the auditor can obtain audit evidence in the form of legal proceeding files, can meet separately with the legal counsel to understand the probability wherein the winning probability of the client, to understand the entity will do well legally, or if there is no a major financial blow if the entity loses its legal cases or not. So in this case also, going concern can be tested once proper information is obtained from the legal counsel. Next, we have evaluation of entities' plan to deal with customer orders. So the auditor can obtain its marketing plan, budgets, sales plan to meet all the customer orders in the future. This acts as a very good financial indicator, and it shows the intent and how the management plans to be profitable in the future. In fact, I should draw your attention towards a geriatric product. Now, there also the evidence on the basis of which the management could foresee to continue in the future was because they carried out technical feasibility studies, they carried out market surveys. So that is an audit evidence that the auditor can obtain in this particular procedure. Next, we have confirmation of existence, terms, and adequacy of borrowing facilities. Now, the auditor can obtain evidence in the form of borrowing agreements, sanction letter, stock and debtor statement, and charge creation. Now, these documents have also been mandated by Schedule C and CARO as well, starting from previous year. because this basically tells that with the borrowing facilities that are reflecting in the financial statements, they are appropriate or not. So this is also a good audit evidence. Next, we have the checking of the compliance culture. The compliance atmosphere of an organization tells a lot about how it runs its operations because it shows discipline, it shows vision in the management. So, in carrying out an audit, the auditor obtains evidence in the form of statutory returns, if there are any notices or demands that are present, and how is the management dealing with them. In fact, there is a specific clause in CARO wherein the statutory dues are need to be reported by the auditor. So this kind of evidence comes handy in that scenario and also to comment upon the going concern assumption. Next audit procedure we have is the determination of adequacy of support for planned disposal of assets. Now, if an entity plans to dispose of its assets, first, it should not be an indicator of shutting down its operations. It should have a justification as to why they wish to dispose of the assets. A. B. If they intend to dispose of the assets, what kind of support, whether it is financial, whether it is the form of staff, if they have enough customers, that kind of factors need to be checked. For this, the management usually prepares a management plan as to how it will deal with the disposal of assets. So this management plan is a very important audit evidence in this kind of a scenario when the auditor is carrying out this audit procedure. Lastly, checking of the financial arrangements with the related and third parties along with the financial ability. So when it comes to related party, the terms and conditions of transaction play a very important role in determining its fairness. The concept of arm's length pricing comes handy then. So that is what the auditor needs to establish, that A, if there's an arrangement, what are the terms and conditions, if they are at arm's length price or not. And also, if the arrangements are made with these parties, what is the financial standing of these parties? So from that perspective, also an audit evidence needs to be gathered. So once these audit evidences are gathered, I will just do a quick repeat of the financial indicators. Now, these indicators are obviously important from management point of view to establish going concern. It is also applicable to auditor because as an auditor, we are assessing management assessment. So we will also use the same base that the management has assessed because in certain indicators, there could be a possibility that the management, it concluded that yes, my entity can continue as a going concern. But on the same aspect, the auditor may have a different view depending upon the results. So these financial indicators also hold good for the auditor to establish whether the going concern assumption made by the management is appropriate or not. Similarly, the operational indicators as well. So when we club the audit procedures along with these operational and financial indicators, it gives auditors a good base. It gives the appropriate audit evidence sufficient to conclude whether the going concern assumption is correct or not. Now we have performed the audit procedures, we have gathered the audit evidences, we have checked the financial and operational indicators. So our next obvious step would be to conclude on an audit. Now the audit conclusion regarding going concern assessment is broadly divided into two parts. First, as an auditor, it is the auditor's responsibility to conclude if there is any material uncertainty regarding the entity's ability to continue as a going concern. So, basis whatever assessment the auditor has made, there could be a chance that the going concern is impaired and there is a material uncertainty that obviously the auditor has to describe. Second aspect is once the conclusion has been made, on the basis of the inclusion, forming of the auditor's opinion. So in the next slides, I will be taking certain case studies wherein we will be discussing the material uncertainty or the material certainty and what will be the nature of auditor's opinion. Before I go on to the case studies, I would like to do a quick refresher on the different type of auditor opinion. The first opinion is unmodified, unqualified, or a clean report. So if we refer to SA 700, it states that the financial statements prepared are clean in non-material respects. They are in accordance with the applicable financial reporting framework. So the opinion stands unmodified or unqualified. The second nature of opinion is qualified. So when we refer to SA 705, the qualified opinion states that the financial statements are materially misstated, or the auditor was unable to obtain sufficient and appropriate audit evidence. The effect of both these two situations was material, but it was not pervasive. I will explain this in my case studies. The next kind of auditor opinion is adverse, which is given on SA 705 itself. This adverse kind of opinion has to be given only when the financial statements are materially misstated in the auditor opinion, and the effect of such misstatement is material and pervasive. Last opinion is disclaimer. This is also given in SA 705. So wherever the auditor is not able to obtain sufficient and appropriate audit evidence, and the effect of this inability to obtain the evidence is material and pervasive both, it gives disclaimer of opinion in its report. Now that we have understood the four kind of audit opinion, I will give case studies opinion ones. So the first section of the case studies will deal with unmodified opinion. Case study 1. The management has prepared the financial statement on going concern basis, and it has absolutely no significant doubt about the entity continuing as a going concern. Because it has no doubts, therefore, no disclosure has been given. In such a case study, in such a scenario, the auditor will give unmodified opinion provided the auditor concurs with the management's assessment and supporting disclosures. That is, the auditor's assessment of the going concern assumption is same as what the management had done. The financial and operational indicators were positive, and it is sure that the management will continue its operations in the foreseeable future. So in this case, the auditor opinion will be unmodified. Case study 2. This is also for unmodified report. It states that the management has significant doubt about going concern. We will go back to the same example so that it's easy for everyone to understand. That A, the client was not sure about selling the oxygen concentrator, which resulted in giving in doubts, but it took mitigating actions in the form of looking for alternative customer base in the form of hospitals, nursing home, etc. And because of its prior experience and its network, it realized that there is no material uncertainty and hence it will continue as a going concern. So the financial statements were prepared on going concern basis. And most importantly, these 4 disclosures were given by the management in the notes to accounts. So in this particular case study, the auditor will give an unmodified opinion because it concurs with the management assessment and it realizes that the disclosures given in the financial statements are adequate. Before I move on to further case studies, I will give a brief introduction to the concept of emphasis of matter paragraph, which is stated in SA 706. So if in the auditor's opinion, there are certain facts or there are certain conditions that are fundamental to the user's understanding of the financial statements, so it encloses an emphasis of matter, EOM paragraph in its audit report, with the intention to draw the user's attention to the particular matter stated in the note. In EOM paragraph, it doesn't mean that the report has been qualified. It is an unqualified report, but the matter is of such importance, it gives an additional paragraph under the heading emphasis of matter in its report. Now that we have understood what is the meaning of EOM paragraph, we will continue with the case studies. These case studies will be dealing with the combination of unmodified report and the emphasis of matter EOM paragraph. In particular scenario, this is basically scenario number 3. Again, I will refer back to the example. The client has significant doubt regarding selling the oxygen concentrators, but it took the mitigating action in finding an alternative product for geriatric care products. Because of its experience, because of its technical feasibility, it made judgment that it will be sufficient for making the going concern appropriate. But because it was a new sector altogether, they were not sure if the same kind of sales can be achieved with this particular product. So there was material uncertainty regarding going concern, even after the mitigating action of taking that new product was taken. So in this scenario, the management prepared the financial statements on going concern basis, and it gave these 4 disclosures in the notes to accounts. They were honest about it. So in this scenario, the auditor will give the unmodified report, okay? And then it will state that the management disclosure is adequate. I'm sorry, there was a switch off slide. So basically, we need to refer this slide. It will state that okay, let's forget this slide. I'll explain this to you. So in this particular scenario, the auditor's report will be unmodified, okay? And it will state that even though this report is unmodified, it will give an emphasis of matter paragraph in the report, wherein it will state that it will draw the attention of the users towards that paragraph. It will state the fact that, the oxygen concentrators, the sales had to be dropped, and they have ventured into a new sector altogether of geriatric care product. It's a new sector. That is why they are not sure whether the going concern assumption can continue or not. So in spite of that paragraph, the report will remain unmodified, but it will draw the attention towards that EOM paragraph. Next scenario of unmodified report and EOM is the last case, the last scenario 4 that we had taken, that the management did not have the intention to continue because it knew that the going concentrators cannot be again sold, and it did not have bandwidth to expand its operation. So it was shutting down its shop. So it created its financial statements on an alternate basis, that is on liquidation basis. It was not going concern. So in this case, it also gave appropriate disclosures in the financial statements. Now again, my financial statements will basically be prepared, and the auditor will give an unmodified opinion because it is satisfied with the adequacy of the management disclosure. And then after this, the basis of opinion paragraph in the report, it will add this new paragraph regarding the EOM, which is the emphasis of matter. The heading will be this in this scenario, that the liquidation not going concern basis of accounting has been given. The language will be like this: we draw attention to note X of the financial statement, which indicates the conditions and events. That is, the oxygen concentrator supply had fallen down, and the management does not intend to sell these any longer, and they cannot come up with a new product. So as stated in note number X in the financial statement, they are drawing attention here. These conditions, along with other matter as stated, indicate that a material uncertainty exists, which may cast significant doubt on the company's ability to continue as a going concern, and hence they have adopted liquidation basis of accounting. So our report is not modified in respect of this matter. So even though the entity is not continuing as a going concern, it is making a financial statement on alternate basis, still the auditor is giving unmodified report. Next, we will move on to case studies relating to qualified report. Now, when does the auditor qualify the report? We will refer back to the example again. The management is having significant doubt about the going concern ability. That is, the management is again not sure that it will not be able to sell the oxygen concentrators. But they have taken mitigated actions in the form of foraying into the new product of the geriatric care product, which was sufficient to make the going concern assumption appropriate. And there was material uncertainty because the going concern assumption can be affected as it is a new product sector altogether. On the basis of this, the financial statements were prepared by the management on going concern basis. But not this scenario changes. In this particular scenario, the management fails to give full or inadequate disclosures. It has not given full disclosures. Because the disclosures are inadequate, in this scenario, the auditor will give a basis of qualified paragraph. Basically, it will qualify the report. So in this case, I will read this out for you. The auditor will give opinion in such a manner that, as discussed in note number so and so, the company does not foresee future sales of the oxygen concentrator, which was the primary product in terms of sales. So herein, the auditor is saying that there is a note in the financial statement, but in order to prove its inadequacy, it will state, hence, it has planned to venture into the new area of geriatric care products. The company has not conducted any financial or technical feasibility study with respect to future demand in order to cover up the loss of sales of the oxygen concentrators. Now, this effort was missing, right? And this was the reason why the auditor was not sure that why the financial statements are being prepared on going concern basis. This particular aspect was very important to cement the intent of the management to cover up the material uncertainty and to continue as a going concern. So therefore, the auditor will state, the note has failed to mention the significant fact, which indicates a material uncertainty, which is the inadequate disclosure, which may cast significant doubt on the company's ability to continue as a going concern, and therefore it may be unable to realize its assets and discharge its liabilities in the normal course of business. Therefore, the financial statements and the notes thereto do not adequately disclose this fact. This is the way the auditor will prove as to why the opinion given is qualified. The second disclosure that it needs to make is in the report and other legal and regulatory requirements section of the auditor report, which is a requirement of section 143(3)(h) of the Companies Act. It has to state the matter described under the basis of qualified opinion para, which is this paragraph, related to going concern may have an adverse effect on the functioning of the company. This is how the auditor explains why the qualified opinion is being given in such a scenario. And now in the qualified opinion paragraph, it will state, in our opinion, and to the best of information and according to the explanations given to us, except for inadequate disclosure of material uncertainty relating to going concern, referred to in the basis of qualified opinion paragraph, which was this one, the aforesaid financial statements, they give a true and fair view. So except for the information that is contained in the basis of opinion basis of qualified opinion paragraph, the financial statements give true and fair view in conformity with the AS and other accounting principles generally accepted in India of the state of affairs of the company as in 31st March, this is the reporting period, the P&L of the year, and the cash flow for the year ended on that date. So this is the kind of disclosure, this is the kind of opinion that the auditor needs to give in such a scenario. Another example of qualified report is this case study, wherein the management knows that the oxygen concentrators cannot be sold and it cannot come up with an alternative product. So it is liquidating and ceasing trading. It is not going to continue its operations. Okay. And because the operations are not going to be continued, it prepares the financial statement on an alternate basis, which is liquidation basis. But it fails to give disclosures or it fails to give inadequate disclosures. Just see the importance of disclosure. It can change the opinion of the auditor. Now, in this particular scenario, the auditor will give, again, it will give a qualified opinion. The language will be like this. This is all illustrative. It is to explain to all of you in a better manner. The entity's current business cannot continue due to significant fall in demand of the oxygen concentrators. The entity's management does not have any alternative product or project to rely upon to continue its operation. By this, the auditor is highlighting the intention of the management to shut its operation, to highlight the material uncertainty as to why the entity cannot continue its operations. The situation indicates that the materiality uncertainty exists because of this particular fact, which can cast a significant doubt on the company's ability to continue as a going concern. It also states the financial statements have been prepared on liquidation basis, but the financial statements do not adequately disclose these facts. That is why the opinion in this case is being qualified. Under the qualified opinion paragraph, the auditor will mention, in our opinion, and to the best of our information, and according to the explanation given to us, except for inadequate disclosure of liquidation basis or preparation of financial statements, which was this particular paragraph, wherein the auditor explained that even though the operations are being liquidated, this fact has not been disclosed because it was of prime importance for the users of the financial statements. It should have been given in the notes to accounts by the management. Coming back to the qualified opinion paragraph, the aforesaid financial statements give true and fair view in conformity with the AS and other accounting principles of the state of affairs of the company as in so and so date, and the P&L of the year and of that date, cash flow for the year ended that date. So this particular language remains common. The auditor is required to only highlight the aspect related to the paragraph, the basis on which the qualified opinion has been given. Moving further with the case studies, with this we are done with the case study relating to unmodified, unmodified plus emphasis on matter paragraph, and qualified. Now we will see the case studies related to adverse report. Coming back to the scenario, this is scenario number 3 from the management section of the slide deck. Again, the client, it has significant doubt because the oxygen concentrators are not being sold, right? And it took mitigating actions by foraying into sectors such as, the new geriatric care products, which make the going concern assumption appropriate. Because it was a new sector, it knew that there will be material uncertainty about the entity to continue as a going concern. All right. So in this case, the financial statements were prepared on a going concern basis, but it failed to give no disclosure. It gave no disclosure in the financial statements. So when an entity in such a scenario, the management decides to forego the disclosure part, it basically raises a question mark on the intent of the management. It basically shows that the management is hiding this fact because the management itself is not sure if the entity will continue as a going concern due to the fact that it is a new product area and there can be failures. So it does not want to disclose this fact to the users of the financial statement because it can affect it. The financial institutions may lose confidence in them. The investors might not invest in them. So this is basically a lack of intent of the management to disclose this very important fact in its financial statements. Hence, this is like, the situation becomes pervasive because of this intent. So if you recall my slide regarding the auditor opinion, where I was giving the difference between qualified opinion and adverse opinion. This case, in this scenario, because of lack of disclosure, the management intent is, of course, it's material, but becomes pervasive as well. So now because both materiality and pervasiveness exist, so in this case, the auditor will give adverse opinion. The auditor will explain. It will basically use this language. The company does not foresee future sales of the oxygen concentrators, which was the primary product in terms of sale. Hence, it has planned to venture into new area of geriatric care products, right? These are just plain facts. The company has not conducted any financial and technical feasibility study with respect to future demand in order to cover up the loss of sales in oxygen concentrators. I'll just stop here. This particular paragraph is similar to what I had given in the basis of qualified opinion paragraph. But in that case, the management had disclosed this fact that we are foraying into a new sector, but it forgot, or due to some reason, it did not disclose that they had carried out they could not carry a technical feasibility study. Now, in this particular scenario, this entire paragraph, this entire note on the entity foraying into a new product sector was missing from the report. So this is the fine difference between qualified and adverse opinion. So continuing with the language of the report here, the events indicate a material uncertainty that may cast significant doubt on the company's ability to continue as a going concern, and therefore it may be unable to realize its assets and discharge its liabilities in the normal course of business. The financial statements and notes thereto do not disclose this fact. This is the basis on which the auditor is giving the opinion as adverse. In addition to this, the auditor also needs to report in the other legal and regulatory requirements under Section 143(3)(h) of the Companies Act. That is, the matter described under the basis of adverse opinion paragraph relating to going concern may have an adverse effect on the functioning of the company. And under the adverse opinion paragraph, the auditor will mention, in our opinion, because of the omission of the information mentioned in the basis of adverse opinion section of our report, which is It had failed to mention the fact that it had forayed into a new product sector altogether, and it had failed to mention the fact that the management could not conduct the financial and technical feasibility study, which resulted in a material uncertainty. Therefore, basis of omission of this very important information in the report, the accompanying financial statements do not give a true and fair view of the financial position of the entity as on so and so date, and of its financial performance and its cash flows for the year then ended in accordance with the accounting standards issued by the ICAI. So in this particular paragraph, the auditor is explaining that, listen, I do not have confidence in the financial statements, for which I have already explained why. And there is a doubt on the management intention. So this is basically a warning to the user of the financial statements that you look at it from your own perspective. This is the risk that I wish to highlight as an auditor. Next case study on adverse report is regarding this situation, that the management now knows that I will have to liquidate the operations because the oxygen concentrators cannot be sold. There is no realistic alternative. I cannot come up with new product ideas. Fair enough. And now, even though the management is liquidating its operations, ideally, if we go as per the AS, the financial statement should have been prepared on liquidation basis or market rate basis. But in spite of existence of this intent to liquidate and cease its operation, the management decides to prepare its financial statements on going concern. And on top of it also fails to give the disclosures. Now, this again becomes, a very adverse situation. It is material that obviously the facts should have been disclosed here, but now because they have changed the basis of preparation of the financial statements, they are highly misstated because the base is not the liquidation or market rate, but it is a going concern basis. So the financial statements are wrong. So that is what adds to its pervasiveness. So since both materiality and pervasiveness are present in this scenario, in this case study, that is why the auditor is forced to give an adverse opinion. This will be the language or the basis of adverse opinion. The entity's current business cannot continue due to significant fall in demand of the oxygen concentrators. The entity's management does not have any alternative product or project to rely upon to continue its operations. The situation indicates that a material uncertainty exists, which may cast significant doubt on the company's ability to continue as a going concern. In spite of such adverse situation, the financial statements have been prepared on going concern basis. So the auditor has highlighted the adverse situation here that, there was significant fall. They do not have any alternative product or, any source through which they can continue its operations. This was a major material uncertainty in the mind of the management, but they failed to disclose it. The intention of the management was wrong. Moreover, they also prepared the financial statement on going concern basis in spite of the presence of these adverse situations and conditions. And hence, the financial statement do not adequately disclose these facts as well. So this is the basis that the auditor is required to give in the auditor report. And in the adverse opinion paragraph, the auditor will mention, in our opinion, because of the omission of the information mentioned in the basis of adverse opinion section, which was these two facts, that there was, the preparation of the financial statements on going concern basis and lack of disclosures. The accompanying financial statements do not give a true and fair view of the financial position, that they are highly misstated, of the entity as on the reporting date, and its financial performance and its cash flows for the year then ended in accordance with the accounting standards issued by the ICAI. With this, we come to the end of the case studies relating to adverse report. The last section of the case studies relates to disclaimer of opinion. Now, there's only one case study regarding this, which I'll explain. The management somehow fails to carry any kind of going concern assessment by the management. So, as I've explained in my management section of the deck, wherein I said that the going concern assumption has to be tested by the management, has to be established by the management on the financial and operational parameters. And the financial statements on going concern basis cannot be prepared if the assessment is not present. So if in certain scenario, the management forgoes or it has no way to prove that the financial statements have been prepared on going concern basis, then in that case, the auditor has no base to rely upon, right? How, and also there can be a situation wherein the management is not sharing the information, it is not cooperating with the auditor, and it also repeatedly, is causing distress in the audit. So there is, there is no basis. I mean, the aspect linked disclosure is not even relevant here. It is not even a point here. So in this scenario, in spite of these adversities, the financial statements are again prepared on going concern basis. So how will the auditor deal with this? Now, in this scenario, the auditor will give a basis of disclaimer of opinion paragraph in its report. It will state something like this, that we as auditors were not allowed access to the management's assessment of the ability of the entity to continue as a going concern. I, as an auditor, am not aware if the management has carried out the assessment or not, because I have not been shared any evidences that I asked for. I could not perform any audit procedures. I could not do my responsibility. I could not understand the process. So we could not perform any audit procedures or gather sufficient and appropriate audit evidence to provide a basis for the audit opinion on the financial statements. This is very clear. The auditor is very honestly stating that, I could not perform the audit procedures. I could not gather any sufficient or appropriate evidence. Therefore, I cannot comment upon if the financial statements they are giving true and fair view, if the going concern assumption is appropriate or not. In the disclaimer of opinion paragraph of the report, the auditor will give the simple statement: we do not express an opinion on the accompanying financial statements of the entity. Because of the significance of the matters described in the basis for disclaimer of opinion section of a report, we have not been able to obtain sufficient and appropriate audit evidence to provide a basis for the audit opinion on this financial statements. In this 3 lines, the auditor is making reference to this particular paragraph, wherein we have stated as an auditor that, listen, I was not given access to the information. I do not have any base to justify if the financial statements have been prepared on going concern or not. So these are the different audit opinions depending upon scenario to scenario. In my next 2 slides, I have prepared a summary so that we can have a quick revision as to in which scenario, which kind of auditor opinion should be given. So I will quickly walk you through this. In scenario number 1, the management has no significant doubts, right? And the financial statements are prepared on going concern basis because there is no doubt. Therefore, if as long as the auditor is satisfied with the management's assessment of going concern, there are appropriate disclosures given, and there are enough present, then the report given would be unmodified. In second case study, there is this presence of significant doubt. Again, we will refer back to that example of the oxygen concentrator. There is doubt in the management's mind regarding sale of the oxygen concentrator, but it is sure that it can be sold to an alternate base of customers in the form of hospitals, nursing homes, which was the mitigating action. And because this is something which is the management is, the product line is same, so there is no material uncertainty with regard to the entity to continue as a going concern. And that is why the financial statements are prepared in this particular scenario on a going concern basis with adequate disclosures in the financial statement. I'm laying stress upon the word adequate disclosures. So in this scenario, the auditor opinion, of course, it will be unmodified if I'm agreeing with the management assessment, but I know that there can be a scenario wherein I need to draw attention towards the management. So I will give an EOM paragraph. In scenario number 3, the management intends to liquidate or to cease trading. Now, this is a case wherein the management knows that, I cannot continue the operations of selling the oxygen concentrators. I do not have enough resources to expand my operations. So I cannot give going concern assumption. And therefore, I will not use going concern basis, but an alternative basis, let's say, liquidation basis, to prepare my financial statements. Along with this, the management is also given adequate disclosure in the financial statements. So here also, if the auditor is concurring with the management's assessment, it is satisfied with the audit procedures and the audit evidences, the auditor will give an unmodified report, but it will give an emphasis on matter paragraph, wherein it will draw the attention towards the disclosure in the financial statements regarding as to why the management decided to discontinue from going concern, what were the conditions. So because this from auditor perspective is important for the user of the financial statements. Our next case study dealt with a scenario wherein significant doubt, the oxygen concentrators cannot be sold because their demand has fallen down. Mitigating action, because the oxygen concentrator technology is no longer valid, so the mitigating action in the form of foraying into a new product line of geriatric care products was taken. Third, in spite of making all the efforts for promoting the particular product, for carrying out campaigns, from training the staff, for doing technical physical studies, there is a certain material uncertainty in the mind of the management because it's a new product line altogether, and there are a lot of external factors that can affect the sales, and it may not be able to reach the level of the sale of oxygen concentrator. So, in this particular scenario, the management proceeds with preparing the financial statement on going concern assumption, but very importantly, it gives inadequate disclosure in the financial statements. That is, they have given the 4 disclosures that were to be given in this scenario, but not all 4 disclosures have been given. There could be 2, there could be 3, and in the auditor opinion, it is inadequate. So, due to this inadequacy of disclosure, the effect on the financial statement, it is material, but it is not pervasive. And that is why the auditor gives qualified opinion, but not adverse opinion. Next scenario. Again, there is significant doubt because the oxygen concentrators cannot be sold. Secondly, they took mitigating action in the form of foraying into the new sector of geriatric care products. There is material uncertainty in spite of all the actions in the form of technical feasibility study, then promotional campaigns, all is there. In this case, again, because these 3 conditions are present, so the management went ahead and prepared the financial statement on going concern. But there was lack of intent in the management's mind to disclose the material uncertainty regarding this condition and these events in the financial statement. They purposely omitted this information. And because the intent of the management was wrong, it was inappropriate. So the auditor went ahead and gave an adverse opinion. Why? Because the effect of such non-disclosure was material and pervasive both. Again, in qualified, it is just material, but it is not pervasive. In adverse, it has to be material and pervasive both. Next case study. The management knows that it cannot sell the oxygen concentrator and it does not have enough bandwidth to expand its operation. So it has the intent of shutting down its operation, right? But in this case, they have also know that the going concern assumption is not valid in such a scenario. So they went ahead and took alternative basis of preparing the financial statement, not going concern. But even though they went ahead with using alternative basis of accounting, they did not give or they gave inadequate disclosures in the financial statements. In this particular scenario, the effect of non-disclosure is material. There's an error here. It should have been not pervasive. So basically, non-disclosure is material, but it is not pervasive because the basis of accounting is appropriate, right? It is just a disclosure is inadequate. Okay. Same example, that is, I do not wish to discontinue my business of oxygen concentrator, and I know that the going concern is impaired. But in spite of the management's knowledge on this particular fact, it did not want to disclose it to the users, and hence it prepared its financial statements on going concern basis. So this is like the worst case scenario because here the accounting is incorrect itself. The financial statement should have been prepared on liquidation basis or alternative basis, but still it went ahead and prepared on going concern basis. So now the effect of preparation of the financial statement is inappropriate, and the misstatement due to such usage of going concern basis is material and pervasive both. And therefore, in this scenario, we have used adverse. We've given adverse opinion. Lastly, we have no going concern assessment is carried out. Now, when no going concern assessment has been carried out by the management, this means that the management has absolutely no basis as to why the going concern assumption has been used. That why has the management prepared the financial statement on going concern basis? So lack of assessment meant the management was not cooperating with the auditor. So the auditor basically had no information, no audit evidence. It could not perform any audit procedure to conclude whether the entity can continue as a going concern or not. And in this scenario, the auditor will go ahead and give disclaimer of opinion to the management. So with this, we have covered the auditor aspect of the going concern. And now I've come to the last slide of my deck, wherein I'm just showing my coverage as to what all we have understood with respect to going concern. In the first section of the deck, we understood the introduction to the going concern, that what was the concept, where it is covered, where does it come from, and what is the meaning from both, which is applicable to both management and auditor. In the second chapter of the agenda, of the deck, we understood the going concern from the management responsibility perspective, wherein I made you understood the going concern assessment indicators, operational and financial both, what was the responsibility of the management, how will it assess, and this how aspect was addressed by the four case studies, the four scenarios, wherein I also gave the summary slide. Once we understood what was the management responsibility, the last section of the deck dealt with the auditor responsibility, that now the management has assessed and prepared its financial statement on going concern basis. The auditor needs to conclude whether that assessment is correct or not. So there were certain steps to be performed for the evaluation. There were audit procedures to be performed, audit evidences to be gathered. And lastly was the audit conclusion, wherein I took the case studies and scenarios from the management section and I linked them with the different kind of opinions and different kind of reports that will be given by the auditor. Thank you so much for the patient hearing. And now I can open the forum for questions. Sir, can we start with the questions? Tech support team, am I audible? Okay, so can you get in touch with someone to start with the question section of this? Sure.
Thank you, madam. Can you hear me, ma'am?
Yeah, I can hear you.
Thank you so much, ma'am, for such a detailed and wonderful deliberation. Ma'am,
My pleasure.
whether the going concern concept covers both the corporate and non-corporate entities?
Yes. So because accounting standard 1 is covered for both corporate and non-corporates, and Ind AS is covered on certain listed entities and certain, there are certain levels. So this concept is applicable to both corporate and non-corporate entities.
Ji, ma'am. Ma'am, one question is, one member is saying he has seen balance sheet where funding by promoters through unsecured loans on short-term basis. However, firm has lost. How would be such firm is going concern?
So in this case, can you repeat the question? I think I lost a fact in between.
One member is saying he has seen balance sheet where funding by promoters through unsecured loans on short-term basis.
Okay.
So, however, firm has losses. So how will we find out that such firm is in going concern?
So in these cases, you need to losses can be there in spite of presence of fund. But if the firm is, if the entity is making repeated losses, I had also mentioned in the financial indicators slide that recurring operating loss is also a red flag regarding going concern. So in this case, you can question the going concern assumption of the management that even though your funding is there from in the form of unsecured loans from the promoters, but you're making recurring losses. So what is the justification behind it? And if the auditor is convinced that there can be a time when the product can pick up, where the company can become profitable, so the going concern assumption is appropriate. But if it is not the case, then it can qualify the report.
Ma'am, in your opinion, what is the basic difference between breakup value accounting and liquidation accounting when financial statements are prepared based on the going concern?
Okay, so first of all, if the financial statements are being prepared on going concern, then the liquidation based accounting cannot be used, because that is the basic concept of going concern, that if an entity is a going concern, that means it is going to continue on foreseeable basis, and it will use historical basis of accounting. The liquidation basis of accounting or market value basis of accounting is to be used when the intent of the management is to liquidate the entity, that now the conditions and events are such that it cannot foresee that it will continue in the future. Like the example that I gave of the oxygen concentrator company, that it knows that there is no way I can get this kind of revenue and I don't have an alternative source. So now I am in the process of basically disposing of my assets. That is why I use the liquidation base or market base. So the question, I think either it has to be rephrased, or this is the basic difference.
Ma'am, is one question is relating to GST. What happens if GST number gets suspended and business comes to an halt? Without GST, business cannot be done and matter is pending in court. How to justify as a going concern?
Okay. So first of all, if the GST number has been suspended, as an auditor, you need to check if the efforts that the management has taken in place to, retrieve its GST number back. Does the management intend to revive its GST registration? If yes, then that is a valid evidence. The evidence can be in the form of an application, because you can always write an application to the officer to, cancel the revocation of the GST number. That is, the mechanism is there in the GST portal. That is a very good indicator of the intent of the management to comply with GST. If that step is not taken, then you need to understand with the management as to why they are not going on a GST route. Now again, if we go back to the financial indicator side, I had mentioned non-following of statutes is basically an indicator of lack of discipline in the management. So if the management does not want to comply with the GST compliances, that means there is something wrong regarding going concern. So in this particular situation, you can qualify the report unless you have a justification on the management. Sometimes the officer is taking time to revert back to the application. So there are two cases. If the management has filed an application for revocation of cancellation registration, and they are able to prove that they intend to meet the GST compliances, then the auditor will give an unqualified report, but it can give an EOM, and the auditor needs to ensure that this disclosure is given in the financial statement. The scenario two is that no, the management has taken no steps to approach the officer to revoke the cancellation. They are okay with it. They wish to continue their operations. They're least bothered about the GST compliances. Since this is a more important red flag, in second scenario, you can qualify the report.
Yes, ma'am. Ma'am, where a company is not doing any business since its incorporation or stopped its business after some years, what will be the status of the company, whether going concern is impacted?
Okay, so if a company is not doing any operations, again, till the time it is continuing, not doing an operation, that could be due to because of technical snags, or they are still in the testing phase of the product, or they're yet to, begin their operations. So that does not mean that they do not wish to they don't wish to continue with the operations. So if only this fact is present, then the going concern assumption is there. But you have to see for other factors also, like if it's a newly set up entity. In a newly set up entity, you need to have certain staff. There has to be an office. It could be a virtual office. There has to be an idea in place. There has to be a bank account. There could be, the PAN is present. The registration has been taken. So that these are fair indicators of the intent of the management to start the business. Then also, depending upon the nature of the business, there's certain businesses which take time to pick up. A newly manufacturing factory, a new product wherein the market is very new, the customer is very new, so we don't know if it will pick up or not. But you need to get comfort from the management that what is your plan to break even in this kind of product. Let's say they've made a 5-year plan. Now 5 years have ended and still the product has not picked up. So what is the mitigating action the management has taken to counter this kind of situation? So even after 5 years, the product has not picked up and the management has not taken any action, they're not sure, then you can start questioning the going concern. And coming to the last fact of this question, where it states, now they feel that their plan was not correct and they cannot launch the product, and now they've run into losses also. They do not have resources to continue the operation. So this is a very fair indicator of going concern impairment. And if this scenario is present when the management admits that, listen, I will liquidate my operation, so we have to ensure that the management has prepared the financial statements on liquidation basis, not going concern basis. It has given the disclosures required by the AS and SA, and then you can give an unqualified opinion with an EOM, that even though the opinion is unqualified, but in the EOM paragraph, the auditor will mention that, listen, the operations were being discontinued, therefore they could not continue as a going concern, and hence they use liquidation basis of accounting.
Yes, ma'am. Ma'am, in case of a subsidiary, is the company funding its operation by seeing further capital infusion from its parent, whether it can be an indication of the going concern? If yes, why so?
If the parent company is funding the subsidiary company, so first in that case, the auditor should obtain the evidence in form of terms and conditions, because it's a related party transaction. And also, they should not be adverse in situation. And the transaction, if apart from funding, there's also sometimes, they are a transaction in the form of sale and purchase. So that should be carried out at the arm's length price. But this cannot be enough to question the going concern. If the funding is there, and let's say the operations are being carried out in a smooth manner, and the company is profitable, the ratios, the key ratios, financial ratios, they are positive. There is no adversity there. So, in my opinion, I mean, I think the more facts are needed in this question to comment upon the going concern. Otherwise, I don't see any red flag just because the parent company is funding the subsidiary company, provided the conditions and terms are not adverse and there is no breach of these conditions by the subsidiary company.
Yes, ma'am. Is there is a material uncertainty? Would there be a CAM reporting as well as reporting in the audit report? If there is a material uncertainty, then would there be thereby a CAM reporting as well, reporting in the audit report?
Sir, can you repeat the question? I missed it.
If there is a material uncertainty, would thereby a CAM reporting as well as reporting in audit report?
So if there is material uncertainty, that means there is significant doubt in the mind of the management regarding the going concern assumption. So in this case, the management if this is a situation, the management should have taken mitigating actions to cover that significant doubt. And if this was done, they have made the financial statements on going concern basis. But most importantly, in this particular scenario, the disclosure regarding the significant doubt, the mitigating action taken, how they intend to deal with the doubt. And the most important disclosure is that in spite of these mitigating actions, there is a material uncertainty. They have to explain why the material uncertainty is there. If these disclosures are present in the financial statements, then the auditor will give unqualified opinion, but along with the emphasis on matter paragraph, where the auditor will draw the attention of the users of the financial statements to these disclosures that, listen, there was a significant doubt, they had mitigating action, but in spite of mitigating action, there is material uncertainty.
Yes, ma'am. Ma'am, in case of the small companies in Mofussil area, interim financial statements, sale projection, etc., will not be available. Right. What can be done in such cases to substitute, in case of to substantiate the management assertion that entity is a going concern? So, interim financial statement and projections are not the only audit evidences. If you refer to the financial indicator slide, I talked about negative cash flows. I talked about key ratios. I talked about minutes of meetings. I talked about, if there are borrowings, then you can refer to the sanction letters. So, yes, madam. Although interim financial statements and projections are good base, they are solid audit evidences, but they are not the only audit evidences. If you refer to the audit procedure slide, I have given a list of 10 to 12 audit evidences. So they can be evidences that can be substituted. For example, if a small and medium company has taken any working capital facility from a bank, so in that case, it must have submitted, projected financials. So you can ask that,
You can understand the basis on which the loan was given. So there are alternative way of getting the same evidence from the management.
जी ma'am.
Right.
Second last question, ma'am. In case company has applied for the defunct company, whether the financial statement will be prepared on going concern?
Okay. Now, I'm not sure. Sorry. Hello? Am I audible? So there's a lot of disturbance from your end. Hello?
Fine, ma'am.
I'm saying that so I'm not sure the technical difference between sick and defunct company, but if the definition is more or less the same, then sir, would you mute your mic? I cannot speak. Yeah.
Pardon, ma'am?
There's a lot of noise at your end. Can you mute your mic for a second?
It's mute, ma'am.
Okay, I'll continue. So I'm saying that I'm not sure the technical difference between defunct and sick company, but if the parameters are more or less the same, then yes, sick company is a red flag regarding going concern. And the auditor needs to, be very cautious in case of defunct and sick companies. And it needs to understand the intent of the management, that whether in spite of being a defunct company, is there any possibility that the company can continue as a going concern or not. And depending upon that, it will give a qualified or adverse report.
Last question, ma'am. If a case is filed against the company and as such operations of the company has stopped, so in that case, what should be the consideration considered as the going concern assumption?
So this is a very good question that, there was a legal proceedings going on and the company lost the case. And as you said, the fact in the question is that the operations came to a halt. So if the operations have come to a halt and, after, in this case, the auditor, I think, should consult with the legal consultant as well, that is there any scope that in spite of loss of this case, there is a possibility of revival of the operations. You need to check with the management, have they thought of any plan, any mitigating action that they will take to revive the operations. If both of these are absent, then this is not a case of going concern, and the management should have prepared the financial statements on liquidation basis. But if there is a possibility, maybe they will appeal to a higher court, and they are not dependent upon only one certain product. They have diversification of products. The other product lines are doing well enough. Then it is a going concern basis for them. So it depends from scenario to scenario.
So thank you so much, ma'am. Now we come to our end. It was the wonderful deliberation and in a very detailed and lucid manner. And you have explained all the aspects of the going concern relating to audit. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant, we extend our heartiest thanks towards you for sparing your valuable time and enlighten all of us on various intricacies as well as the considerations relating to the going concern. Thank you so much, ma'am.
Thank you so much, sir. Thank you to all the professional fraternity. Would love to connect with you professionally. Thank you.
Thank you, ma'am. Thank you.